Hey everyone, welcome. My name is Atish Davda. I'm the CEO and founder of EquityZen. We're a platform that helps folks make private company investments. I'm absolutely delighted to have this talk with our guest today, Chuk. For those that have followed for a while, will remember he used to help run product at EquityZen back before the pandemic. Since EquityZen, he helps to run product at Paxos, which is a blockchain infrastructure company. He's become a leading voice in the blockchain world. Stablecoin specifically. He's the author of the Stablecoin Blueprint. He's also a stablecoin editor at This Week in FinTech. Before EquityZen, Chuk was at Silver Lake, Morgan Stanley, Harvard Business School, and University of Oxford. Chuk, thank you. Thrilled that you can make time to share some insights with us.
Awesome. I'm really glad to be here, and it's great to see you again, Atish.
Well, let's dive right in. Look, stablecoins, everyone's talking about it. It is a crucial bridge between traditional finance and the crypto world. I know a lot of the folks who are going to be watching this want to know what it is, why it matters, and candidly, how they can get exposure to it or not get exposure to it. What are the investment implications? So we're going to start right at the top. Chuk, what exactly is a stablecoin and what problem does it solve?
Yeah, I think the way I usually start is just really simply it's a digital dollar. And there are lots of different forms of digital dollars, but stablecoins are digital dollars on the blockchain. And so instead of it being on a closed platform, say Venmo or PayPal or any other kind of digital wallets that you may have used, you now have the ability to move this around globally in a permissionless way. And there are lots of benefits that come with that 24/7 movement, really fast and really cheap. And that has lots of implications in lots of different use cases that I'm sure we'll go into. But some of the biggest ones are payments, cross-border payments, dollar access, and there's so many things that come out of that ability.
That's great. One of the things that we hear a lot of times is that there's different models for this. There's fiat-backed. And can you just talk a little
Yeah.
bit about what some of the different models are?
Right. And so the word stablecoin doesn't really tell you too much other than, okay, it's a way to peg something to a stable value, right? And there are lots of different ways of doing that. And there were different ways of pegging the on-chain token to the real life version of the currency will determine what type of stablecoin it is. And the ones that are the largest, the most secured, the most popular are fiat-backed, i.e. you take the dollar and you stick the dollar in a bank account. With enough, you invest those dollars in very, very secure assets, such as usually short-term treasury bills, cash and cash equivalents, and a range of other assets. But once you do that, it means that you have a very, very secure and clear matching of dollars held off-chain and the representation of those dollars on-chain. So those are what are typically called fiat-backed stablecoins. And the recently passed Genius legislation is aimed at those types of stablecoins. So, and there's a very, very clear stipulation around what you can put those reserves in, and we can talk about a bit about that later. And then there are other stablecoins. So I think many folks who are just around the space have heard of Terra Luna. That was a stablecoin that crashed. The key distinction there being it was a algorithmic stablecoin. Like, what does that even mean? It's they tied the value, the peg, to an algorithm that was based on some other assets. Those other assets were not necessarily backed by anything of valuable in and of themselves, and the mechanism to maintain the peg was not robust. That led to the fall of Terra and the Terra Luna ecosystem. But it's important to make that distinction of backing things with assets, like fiat, or algorithms. And then there are other assets you can back things with. I think the collateral-backed stablecoins are an interesting one to think about, where you can use assets with value that you have large liquidity in, such as Bitcoin and others. And then you say, okay, let's take a loan-to-value ratio of, say, 30-40%, and I'm going to then create dollars from that backing asset. So that's how MakerDAO kind of got started. Now their reserves are a bit different. So the MakerDAO is the protocol. DAI is the asset, and there's more to talk about there, but I'm simplifying. But that's another way of pegging a value to a coin. Obviously, that's a little bit different from the fiat-backed, where there's a very, very clear risk mechanism of what the assets underlying are worth and what the stablecoin is worth. And that's that type, the fiat-backed stablecoins, is the one that is gaining a lot of traction. That's where the majority of the stablecoin market cap is today, and that is the type that the Genius legislation is regulating.
That's great. I think one of the things that you heard from Chuk right there is that this will be the 101 class, if you will, on stablecoins. There's obviously a lot more to dive into, but we're going to try to cover some of the primers today. So Chuk, there's clearly a reason. You just started saying this. The fiat-backed stablecoin is getting a lot of support. It's getting a lot of folks interested. Before we talk about how folks are playing in the space, let's just zoom out. Big picture, what is the stablecoin usage longer term, and what's the usage today?
Yeah. And so at the very beginning, I mentioned just digital dollars or a digital currency. And I try to simplify it in that way because that underlies the broader implications. It's a better version of money. And therefore, the use cases of money and the way that money can be used for value transfer, for payments, for other operations to drive the economy, that's a way or the framework to think through the benefit of stablecoins. And so in a more tangible approach, I would say, okay, well, let's look where money is slow and painful to move today. Those are the areas where stablecoin is getting a lot of traction. And so we'll go into these use cases, but moving money around the world is not easy. Domestic payments, depending on the country that you're in, is fairly well solved. And so cross-border payments ends up being a major new area that is gaining a lot of traction with stablecoins. On-chain trading, yes, there's crypto trading, but there's also other assets, real-world assets such as equities. Being able to settle business or other capital markets transactions more efficiently and enabling people to hold value, dollars or other currencies, but mostly dollars today, and we can get into that, enabling them to hold value really, really easily without having access to a US bank account or banking in general. Really, it's, okay, what can money do? What should money be doing? We're living in a world where we can have AI technology that generates feature-length movies, and yet it's very hard to send money between two countries or to settle or fund your investment account. There are many different opportunities there. And in the really, really big picture, so many kind of financial transactions and economic transactions are slowed down or prevented by the cost of moving capital. Once you reduce those frictions, it opens up a lot of economic opportunity. Lots of near-term use cases, but the broader implications really come from a better facilitation of money movement and therefore economic growth.
Yeah, fundamentally, it sounds like when you reduce the friction of being able to transfer value from one side to another side, certainly across borders where it's a lot more challenging than just in the domestic market, you can free up a lot more enablement. It just becomes a lot easier to actually conduct a trade with, a country that
Yep.
has difficulty accessing the US dollar.
That's right. And I think that's the clearest example today because that's where the biggest pain points are today. But money movement for payments and cross-border is just one aspect. A lot of our financial lives comes down to savings and investment. And blockchain technology also facilitates that, makes friction much more reduced. And I can easily imagine a world where as long as you have a smartphone or a powerful enough feature phone, you have a bank account, a trading account, lending, credit, P2P in your phone or in your small device, or maybe in the future it'll be like your AI assistant. But that's where we're going, and payments is one aspect of that. But a lot of financial services is prevented right now due to the cost of providing these services. Many of that comes down to the trickiness of keeping track, ledgering, and serving customers who don't have that much capital. And when you reduce the cost to serve and you make it easy for people to compose financial services because they're sharing a substrate, they're sharing this blockchain layer, then everything becomes really, really cheap and many more financial services can be provided to many more people. So we'll get into that, I'm sure, but that's really the big picture. It's financial services everywhere, being embedded into almost everything.
Well, that's super exciting because one of the things we know about financial services is over time, it tends towards democratization. It starts with folks that only have a large enough transaction to make it worth the pain to go through it so that all the intermediaries can kind of get paid for their efforts. And then eventually over time, technology has shown this over and over again, where you lower those barriers and all of a sudden it's available to everyone. What do you see as the impact on financial services, both the financial services themselves and also the financial services firms, who are the providers of those services kind of as they are today?
Yeah. So I think, if you take the position that it's becoming easier to build these things because one, the technology is getting better. Also, AI is a trend. It's complementary to this movement. In addition to that, because of the shared ledger, you are able to have kind of open app stores where more and more innovations that are built in one area of the economy or another area of the market, they can then be combined together and stitched together. And so that massively accelerates how quickly you can innovate. And so what that means is financial services are going to get cheaper, better, more personalized. And there'll be, depending on how what your investment thesis is, many more options, many more ways to combine financial products. Maybe you want to have an ETF or a equivalent of an ETF that has some exposure to the NASDAQ, some exposure to gold, some exposure to crypto, or some exposure to real estate. The ability to combine those and put them together to create financial products for those people who want them will be increased massively. And so that doesn't necessarily say that that's what you want. But there may be people out there who want that. And now you've empowered the people who create these financial products to serve the end user and match that supply with demand. So that's really interesting. What does that mean for the financial firms? Well, it really depends on what industry you're in and where you're playing, what your customers want, and so on. I think in general, competition will increase. So thinking strategically around what your moat is and what part of your customer's financial life cycle you're serving is key. Now that financial services become easier to build, more composable, and more personalized, anyone who has access to customers and end users can now embed and create these financial products. And so the competition is essentially increasing, which is good for the consumer and good for the business. But it means as a financial services provider, you have to think, okay, what's my moat? What can I do that others can't do? On the one hand, integrating blockchain can give you benefits and so on. But at the same time, the more people that do that, the more democratized that service becomes. And so there's a commoditization question here where can I rely on network effects that are harder to commoditize? Can I rely on bundling of multiple different types of products that lead my customers to want to stay with me because I provide these range of services? So I think that's going to be like the key question. And I think we're seeing it already play out today with a lot of acquisitions of the large financial firms. You've got Stripe acquiring Bridge and Privy. You've got MoonPay acquiring Helio and Iron. There'll be more acquisitions. Ripple acquired Rail. There'll be more as firms realize, okay, I have distribution. I have the end user. I want to get the end user. How do I monetize them?
That's very interesting because if anyone with a phone can essentially have a bank account, and anyone with the infrastructure layer, like the Stripes, like the Ripple that you're describing, can also offer a whole suite of services that previously required banks in order to deliver them. This means that having the infrastructure to have a savings account, checking account, and bank branches, that is no longer a moat, as banks have had for as long as we can remember. And all of a sudden, they're going to have to innovate and they're going to be forced in order to keep up with where the market's going. I think this touches on one of the questions I know is the top of mind for, folks that are watching this, which is folks that are watching this will have a portfolio. Are there holdings in my portfolio that are going to be losers from this? And are there winners from this trend that I should be making sure are part of my portfolio? So how should investors go about getting exposure to the stablecoin market? I should stay up front that, this is not about investment recommendations. Neither Chuk nor I are recommending any particular investments here, and just talking for educational purposes.
Yeah, absolutely. So it's a really fascinating question and one I think about, and one obviously I'm sure all investors are thinking about. There's two ways to kind of approach it. There's the effects on the existing incumbents and the existing fintech firms on other firms that you're investing in. And then there's the new firms that are being born or evolving and innovating in the space. And so the way that I would kind of start it is, well, thinking about the particular use case and industry that your business is in. Okay, we've talked about cross-border payments, a lot of innovations happening there. We've talked about banking, and there's so many different types of banks, regional banks serving, local SMBs, large money center banks who can have exposure to custodying stablecoin services and are already involved in large cross-border payments, and then banks in between. Some of them will make the decision to innovate and think about how they can play in this market. Others won't. And so there's lots of different ways to cut through it. But I think understanding what the trends are and then looking at your particular company and saying, okay, what's their strategy? What has that strategy relied on in the past? Has it relied on inertia? Okay, well, that may continue if their customer base doesn't necessarily need these new services. If their customer base is already being lost to the likes of Wise, or from a business perspective, the likes of Airwallex and Rapid, then they may be candidates to have that loss accelerate as more and more cross-border payment companies come online. And then from the new company perspective, I think it's useful to have a good understanding of who is involved in the stack of stablecoin payments. I'll start from what I think is the bottom of the baseline layer, which is connecting to the rails. On the one hand, you've got fiat rails, so they're banks actually who are part of the stack. Not all banks want to play in this game, but there are a couple of banks like Lead Bank, for example, and Column Bank, and the more fintech folks, and Cross River as well, who now have exposure to this market because they're providing that fiat level, that rail. Then on the crypto side or the blockchain side, you've got the blockchains themselves, but then you have the issuers who are the ones who hold the dollars off chain and put the tokens on chain. They monetize that business in different ways. Everyone's heard about Tether. They're a bit in a league of their own in a way that they have managed network effects first, focused on emerging markets, and are now able to retain most of the yield. Circle, if those who have analyzed the S1, they share much of their yield with their main distributor, Coinbase, and they have other distribution deals with other large exchanges, and the list goes on. And so there's an approach there where you say, okay, if there's going to be a lot more stablecoin issuers are interesting. Full disclosure, I work at a stablecoin issuer, but as we said, this is not investment advice. But then as you move up the stack, you then have the folks who enable companies to interact with the blockchain. So those are infrastructure providers, wallet infrastructure providers who enable fintechs. You can think about an Uber doesn't have access to blockchain today, but they could work with a wallet provider to enable and embed a wallet inside the Uber app. And therefore the user doesn't even realize that they're using blockchain, but they have an on-chain dollar all abstracted away. So there are companies that do that. They're very interesting to look at. One of them got acquired recently, Privy, by Stripe. Another one was acquired recently. Portal was acquired by Monad. So you can see that there's a lot of activity there already, because they're obviously a valuable layer. Moving up the stack, orchestration, call it the PSP equivalent of this world, the ones who are connecting the banks, connecting issuers, connecting liquidity, and giving you one API or one app to move money around. And for them, it's about the corridors, it's about the liquidity, the cost that they can provide. Do they own the end user? Do they not? Are they going to verticalize and add more services? And then you have the end user applications. So someone can build a on-chain version of Chime by stitching together, working with a couple of those orchestrators and having the ability to an embedded wallet to then give you what looks like a bank account. It has ACH, it has wires, it has stablecoins. And then there's equivalent end user applications for business, for payments, for trading, and so on. So having a good understanding of that allows you to see the ecosystem, and then within each business and the use case, of course, there's no free lunch. You've got to go do the diligence on what's their differentiator, who else can do what they can do, how many alternatives are there, and are they building network effects or other moats through some of the services they're providing, or is the world going to end up looking like just a race to the bottom on fees and an exchange? So that's my kind of high level crash course on like the landscape. There's more detail to go into in my newsletters. I can go into this, I think, on taking a look at each existing industry and saying, okay, well, what's going to happen? And I think the answers will be nuanced based on the things that I mentioned, what businesses they're in and how much they want to play and innovate.
It's really important to get educated so that you can not just understand the first order effects of, okay, stablecoins are here. What about payment companies? Western Union's in the news a lot, right? But also the second and third order effects. So what would you say are the biggest hurdles to wider adoption? Is it just incumbents, as you said, just kind of refusing to give way? Is it fundamental kind of risks, whether it's depegging, whether it's regulation, lack of adoption? Let's talk about what are some of the biggest hurdles to wider adoption. And then, maybe we can talk about the key risks that whether or not there's still risks today, there are certainly risks in people's minds.
Yeah. So I think regulation is still one of the biggest hurdles globally. There's a lot of progress that has been made and is being made in the US with the Genius Act, which is a specific stablecoin legislation. Then there's the market structure bill that will do a lot for how crypto itself, certain tokens and the technology is going to be regulated. There's still a lot of education also that I think needs to occur. And so I put those two things together. On the one hand, and that's because, as the more that regulators are educated, the better regulation that they can provide. One of the key impediments has been this regulatory gray area. It's not clear whether these things are payments or assets and how they should be regulated. And actually, although it may seem, depending on what news article you look at, that folks are anti-regulation, the space is very pro-regulation because it's the clear rules of the road that make it possible to plan and innovate. So hence why so many acquisitions have occurred and so much volume is happening this year, because it's clear the path forward in the US. Europe has MiCA and has a lot of other clear payments and kind of crypto trading regulation. Singapore is moving, Hong Kong, Japan, UAE, and as more and more nations bring up their regulation to a clear level and ideally the same level, innovation will accelerate even further than it is now. Right now, lawyers don't know how to provide advice because it's not very clear at all. And not just legal, but accounting guidance, tax guidance, and so on. So there's a lot that still needs to happen. So that's still number one. Progress is being made. Education, as I mentioned, just helping people understand what the benefits are. There's so much noise. And I think it's nuanced, and being able to kind of cut through that noise and say, okay, in this scenario, it's better, but for these reasons. In this other scenario, it's not better for these reasons. And having everyone understand that so we can focus our attention on where there is improvement to be made. And then beyond that, I would say with any new technology, there are new risks. And we mentioned security and the new attack vectors that come from enabling this technology. On the one hand, it's fantastic. You can move billions of dollars in seconds. But on the other hand, wait, you can move billions of dollars in seconds. That means that
in just seconds.
Yes, the risks of phishing attacks and social engineering, the payoff is now greater. And so folks need to manage their security, and there are lots of other folks, lots of companies that help with this, but it's a new risk. It's a new mental model on how to do compliance on chain and how to manage this kind of new payment rail. Specifically to stablecoins, I think the concept of like depegging, which I think is on top of people's minds when they think of Terra, Luna. Part of that comes down to the distinction I made earlier about the type of stablecoin and the fact that if you're fiat-backed, that risk is much, much, much reduced. But really, it's also related to how the reserves are managed, how they are managed. And so, with the Genius Act and other regulation, it's becoming very, very clear, okay, the reserves are here, and not only are they here, but they are regulated in a certain way that the token holders are first in line. If you use like a payment app today that's regulated by MTLs, technically you're an unsecured creditor to the company. And part of what Genius does is it says, hey, the assets are actually senior, and therefore in any kind of failure of the issuer, everyone who owns the token will get the token. First, there's no like corporate assets that will be involved in any bankruptcy. And it's funny because we talk about the major depeg that occurred was a couple of years ago with USDC. The irony there was that it's a liquidity problem, and the liquidity problem was because the cash was held in a bank. The bank was SVB, and if you remember, there was a run on SVB at the time. There's a whole other conversation we could talk about that, but it's the fact that folks weren't sure about SVB. Yeah. Which then said, okay, well, maybe Circle will be made whole on that the small percentage of cash that they were holding in SVB, but I don't want to find out. And so liquidity was the issue, and therefore that's what ends up causing the price to come down, even though after a couple of weeks it's solvent. So it's kind of similar to Lehman, where there's liquidity and then there's solvency. With the regulation, the solvency is very, very highly strengthened. And then the liquidity is going to be one that's driven by how the firm wants to manage its cash reserves. And as many banks and the larger banks are starting to serve issuers, you're getting the JPs, the BNY Mellons, the Citis of the world who, the risk of them failing like SVB is or having a run is much, much more reduced. And also, it's worth saying that many of the issuers are applying for national trust charters to then get direct access to the Fed and therefore not have to rely on any bank at all. It's the banking system that has this, as you know, the fractional reserve risk, hence the need for FDIC insurance. But stablecoins that are fully backed by reserves, particularly reserves that are treasuries, don't have that because it's one-to-one backed by treasuries rather than fractional reserve systems. A lot of different things mentioned there, but I would kind of focus on those areas as, okay, here's the risk, here's how they get improved, here's how to mitigate them as a company. Here are the companies that are helping other companies mitigate them. There's an opportunity there, I'm sure, but that's how I'd summarize it.
Well, it sounds to me like there's definitely an opportunity for folks to understand that, yes, there are some risks. If you continue to not learn from your past mistakes, you could still end up facing those risks. However, depegging of the USDC is just one good example where it's no longer a must-have risk. There are solutions, especially for fiat-backed stablecoins, where that's essentially a solved problem. And so it's important to continue to stay up to date on what's happening there so that a thing that was a problem 2 years ago actually can be solved in a space that's evolving as quickly as it is, with as many dedicated folks thinking as hard as possible to solve some of these problems. One of the key things that we need to cover, we've seen a movie like this in 2017. We saw a movie like this in 2021. Where, sometimes the market gets a little bit crazy. You were with EquityZen during the 2017 kind of crypto craze. One key risk and question mark really is just a matter of timing, right? Is where are we in the adoption cycle? So what do you see as some similarities in today's markets to some of the more cautionary times that we've seen previously?
Yeah, I would say, I guess I'll make 2 points. The first is, I think for the first time, there's like a very clear separation of crypto trading, speculative asset, and real world use case payments on chain finance built on blockchain. And so those can now be detached. And then secondly, talking about the landscape for both, but in particularly for the crypto trading, you have a very different regulatory environment and a different level of adoption from institutions. And so when you put those two things together, I think, what on the crypto trading side, Bitcoin price, Ethereum price, Solana, what's happening to the price. I spend less time on that, to be honest, but I think the key differences here are the institutionalization of these assets, the fact that there's multiple ETFs with multiple billions of dollars of AUM. Some of these things are entering 401ks and endorsed by the biggest asset managers in the world. We're in a different time, but that doesn't mean that there aren't dumb speculative assets that are out there that people will spend their money on. But people are free to do as they wish, as long as the risks are, very clearly outlined. For stablecoins, not a speculative asset. Yes, they can be used to facilitate lots of different things, including speculation, but also, as we've discussed, cross-border payments, on-chain finance, being able to launch a global dollar account, a bank account in many different countries at the same time, capital market settlement for when equities and other real-world assets come on chain. And so I would see that as a detached trend where there's a lot that will happen over the next couple of years.
First of all, stablecoin itself is not the speculative assets, especially if it's pegged to a fiat currency. But also two other key reasons. One is that you see the actual adoption by established state institutions. And two, you see real world use cases. It's not just pursuing it for the sake of the potential. It's like the potential is here today and solving problems today. Chuk, this has been absolutely fantastic. We covered a lot of ground. I'm going to kick it over to you for some parting words for folks as they think about stablecoins.
Yeah, awesome. And thanks for the great conversation. It's good to chat with you as always. There's a lot to cover in stablecoins and blockchain and on-chain finance and thinking of it as a new technology. The way that I ground myself is as a new financial primitive, as a new technology. The key trend, or one of the key trends, is reducing the cost of building financial services. That's something I think is really worth looking out for, because it means that there's going to be more financial services competition. It's like the next era of banking as a service or embedded finance, where if you have distribution, you're going to monetize it. And what I mean by that is if you own the end user relationship, if you have consumers on your application, if you're an Uber or an Airbnb, or if you're a crypto exchange or another fintech app, if you're a social media application, you can now embed financial services, leveraging your existing network effects and starting to add payments, P2P, credit, lending, trading, and so on. And so the race is on to build financial super apps for both individuals and businesses. And that's the thing to kind of keep watching out for, rather than, there's a lot of awesome stuff happening in cross-border payments, don't get me wrong. But the big picture here is the sizes of companies that now can be built has changed. The biggest companies can get even bigger. Small companies can attack more efficiently and more quickly. And then the other side of the coin, I would say, is, and that stuff is also happening globally. We spend a lot of time in the West, in the United States, where financial services access isn't too bad. I think that's where we're going to see just this competition and trying to claw as much out of your distribution. In emerging markets, the delta between what is existing today and what is possible is much bigger. And I think the evolution of financial services there is going to be a step improvement. And so that's another awesome thing to watch as well. There's the great quote, or I guess it's their tagline from M0, which is an issuer. They say, everything is a bank. And I think that's really right. When you can embed financial services into anything, then as long as you have that trust with the user, you can be that person's or the business's primary financial provider, and that's going to change the landscape.
That's powerful. You ended on a note that is certainly thought-provoking for me, that everything is a bank. And so with that, Chuk, I want to say thanks again for the super insightful conversation.
Thanks for having me. It's great to chat.